Welcome to the Deep Dive. We take the noise, the transcripts, and all that raw data from the world of finance, and we boil it down to the essential insights you really need.
And today, we are focusing on an interesting one. It's the extreme value neighborhood retailer, Citi Trends, and we're covering their Q3 fiscal 2026 earnings call.
That call was pre-market, December 2nd. And, it feels like a really critical moment for them.
It really is. Our mission here is to get into the real tension in their results. You have this incredibly strong strategic execution, accelerating sales, but it's set against these persistent challenges on the bottom line.
Right. So we're going to distill all of that, the data points, the operational pivots, and this really ambitious long-range forecast for a company that is right in the middle of a huge transformation.
Yeah, let's get into it.
Let's jump straight to those headline numbers because, like you said, they really presented this misalignment, didn't they? A classic revenue beat, EPS miss.
Exactly. Let's start with the good news, the top line.
How'd they do on sales?
Total revenue for the quarter came in at $197.1 million. And that, that was a substantial victory. It beat market expectations pretty handily.
Which we're sitting where? Around 187 million.
Yeah, about $187.3 million. So that translates to a very, very strong 10.1% year-over-year revenue increase. That's the headline the market loved initially.
And crucially, this wasn't just them, opening a ton of new stores to get that growth. How did the existing stores perform?
That's the key. The comparable store sales surged by 10.8%.
Wow.
And what's truly remarkable here is the consistency. This is now the 5th consecutive quarter of positive comps.
5 straight quarters.
Yeah, which just confirms that their turnaround strategy, which really started about 2 years ago, it's not just working, it's accelerating. The operational momentum is clearly there.
Okay, 5 straight quarters, you can't ignore that. But like you said, the story gets complicated when you look further down the income statement. If sales are up double digits, why did the bottom line miss?
Right. Despite that, phenomenal top-line performance, the GAAP earnings per share, it resulted in a loss of 86 cents.
And the consensus was looking for what? Closer to 79 cents?
Exactly. So they missed that consensus target. And it leaves the market grappling with this conflict, right? You have strong growth, but you have weak margins.
Let's stick with the success side for a minute because that sales momentum is real. What is actually driving this? How is Citi Trends doing this when so many other retailers are struggling with traffic?
The core of it, and they were very clear about this on the call, is their laser focus on a specific demographic, the African-American consumer.
Okay.
Management basically emphasized that this consumer base is highly underserved by, traditional department stores.
Okay.
Citi Trends is leveraging its position as a neighborhood-based off-price retailer.
So it's proximity and relevance.
Proximity and cultural relevance. They are powerful traffic drivers in their specific locations.
And this isn't just like one hot region or one product category, is it?
No, not at all. That's what makes it so healthy. The 10.8% comp was broad-based. All store volume groups, all geographies, and across their core categories, children's, men's, and basics.
So the whole business model is working.
The whole model. And you have to look at the consistency. The 2-year comparable store sales stack, so you're looking at 2 years of growth, is now at a massive 16.5%.
That is a staggering number in this retail environment.
It really is.
Okay, that 16.5% stack, that's impressive. It speaks to execution. Let's dig into that 3-tier merchandising strategy they talked about, because this is where it gets really interesting. How are they serving both the deep value shopper and, the more aspirational one in the same store?
It's all about the treasure hunt. They explain they cater to customers across all income levels because, everybody loves a great deal. Their strategy is designed to capture all of them.
So walk us through the tiers.
Okay, tier 1 is their Citi Score program. Think of this as your essential value-focused basics. This is the volume engine of the business.
Got it.
Tier 2 is the better tier. That's the core offering. On-trend styles typically priced somewhere between $7 and $12.
And then the third tier, the best tier, that sounds like the secret sauce. This is what gets people in the door. Right?
Exactly. This is where they drive the excitement. It's expanding on 2 fronts. First, you have trend-right fashion that's just dramatically below specialty retail prices.
And the second part.
The second front is the real draw. It's these opportunistic, extreme value deals on well-known, recognizable brands. We're talking UGG, Hoka, Jordan footwear.
Whoa, really?
Yeah, often discounted up to 75% off MSRP.
So that has to be a strategic move just to create that urgency that I have to go now feeling. Are those deals margin killers, though?
Management sees them as a competitive weapon. They're targeting this segment to be about 10% of total sales volume, up from maybe 2 or 3% now.
Yeah, that's a big jump.
It is. And while the margins on those specific items might be lower, they're designed to drive a ton of traffic. People come in for the Hoka deal, and then they fill their basket with the higher margin core items. It's a traffic subsidy strategy.
And it seems to be working. Okay, so beyond the sales floor, efficiency is obviously key to supporting this kind of growth. They mentioned some impressive inventory management.
I did. I mean, think about this. Achieving double-digit sales increases while you're simultaneously reducing your overall inventory dollars by 3.1% year over year.
That's a huge win.
It's a massive operational win. It means their inventory is just turning much, much faster, which reduces markdown risk, and a lot of that is being underpinned by speed in their supply chain.
And that speed, I imagine, is tied to their big investment in technology, specifically AI. Can you clarify the difference between the AI tools they're using? They mentioned allocation and planning.
Yeah, and this is a really critical distinction. They have just finished the full implementation of an AI-based allocation system.
Okay, so allocation is what exactly?
Allocation is about distributing the inventory they already own in the most efficient way. It makes sure the right sizes and styles are in the right neighborhood store at the right time.
Which improves sales and cuts down on expensive transfers.
Exactly. Now, the next step is planning. They are now rolling out an AI-based planning system.
And planning is more forward-looking.
Correct. Planning dictates how much product they should buy in the first place. This moves them from being reactive to being proactive.
Yeah.
It's data-driven demand forecasting, which should, really optimize their initial buys and cut markdowns way down the line.
So the operational machine is humming, they're driving traffic, modernizing the back end, but now we have to talk about the margin pressure. This is the reason the stock was so volatile, right?
This is it. The gross margin came in at 38.9%. That's a 90 basis point drop year over year.
So what were the culprits? What's going on there?
There were 3 primary pressures here, and it's really important to separate what's temporary from what's systemic.
Okay, let's start with the temporary factor.
That was freight timing. Management made a tactical choice to pull forward some holiday inventory and the freight expense that comes with it from Q4 into late Q3.
Why would they do that?
To smooth out the flow in their distribution centers, make sure they were fully stocked for the holidays. But it cost them 40 basis points of margin in Q3. That cost won't happen again in Q4. It was just a timing shift.
Okay, so that sounds like a smart operational move that just happened to hit the Q3 numbers. What about the more systemic issues?
The second and, more concerning issue they acknowledged was persistent shrink challenges.
Theft and operational loss.
Right. And the third factor, and this one really hammered the EPS number, was the increase in SG&A expenses.
Selling, general, and administrative.
Yeah. The EPS miss was really exacerbated because SG&A was higher than expected, and a big chunk of that was due to a catch-up on incentive compensation accruals.
Meaning what?
Essentially, management was hitting their internal goals faster than expected, which triggered higher bonus payments that inflated the expense line for this one quarter. So again, it's a non-recurring headwind.
That's really important context. So a planned expense shift and a bonus catch-up. But we still have that shrink problem. Management says the rate is less than 1.5%, which is kind of in line with retail averages. So why the heavy investment in these expensive AI camera systems?
That's an excellent question. The level of investment suggests they view even an average rate as totally unacceptable, or maybe they see a risk of it getting worse.
So they're getting ahead of it.
Aggressively. They're rolling out these new AI-capable camera systems with heat mapping, facial recognition for loss prevention, and deeper work with local law enforcement.
What's their actual target for this?
The goal is clear. They expect a decrease in both the shrink dollars and the shrink rate starting in 2026. They know they have to fix this to hit their long-term margin goals.
And this all ties into their growth plans, right? They want to get this tech in place before they expand.
Exactly. The call confirmed their accelerating growth. They plan to open about 25 new stores in 2026 and then ramp that up to 40 in 2027. The goal is a fleet of about 650 stores.
That's a lot of new stores.
Yeah.
That's risky. How are they making sure they're not just, throwing darts at a map?
No, absolutely not. This is where the AI data discipline comes back in. Their new store selection is highly analytical. They use AI tools based on 3 years of transaction data, geolocation studies.
And it works.
Management says the model has about 90% accuracy in predicting sales for new locations. It lets them replicate their successes and minimize the risk of a dud.
And they're also launching a new loyalty platform to drive even more traffic.
Yep, the Insiders Club. It's launching in Q1 of next year. The goal is to drive deeper engagement, especially with their best customers. They'll use it to give those high-value shoppers early access to those extreme value deals we talked about. It's about using technology to deepen that relationship and capture their full share of wallet.
Okay, let's put on the investor lens now. With all this going on, management raised their full-year outlook. What was the updated guidance?
For the full year, they now expect high single-digit comp growth, and they raised the full-year EBITDA range to between $10 and $12 million.
Which is a big jump from last year.
A huge jump. It's a $24 to $26 million improvement versus their 2024 results. They are signaling very strong momentum.
But the real vision, the big bet they're making, is centered on fiscal 2027.
That's the moonshot. They reiterated their ambitious long-term targets, reaching $900 million in sales, achieving a 42% gross margin.
Which is a substantial improvement from where they are now.
A massive improvement, and generating $45 million or more in EBITDA by the end of fiscal 2027. That is a multi-year bet on achieving both scale and margin recovery at the same time.
Okay, so with that raised guidance and that massive 2027 target, the market reaction on the day seems, well, pretty cynical. The stock was already up over 100% for the year, so expectations were high. What happened?
Expectations were definitely baked in. The stock initially gapped up huge pre-market, maybe 12% on the revenue beat. But as analysts dug into the gross margin dip and that EPS miss, even though it was driven by temporary factors, the skepticism just fueled profit-taking.
And the stock actually finished down on the day.
It did. It faded all day and closed below the prior day's close on like 4 times the normal volume.
So the market is basically saying, we love the sales story, but we don't believe you can fix the margins fast enough.
That is the key tension right there. They've proven they can drive traffic, which is the hardest part of retail turnaround. Now they have to prove they can monetize it efficiently. Hitting that 42% gross margin target is now the critical swing factor.
All right, we're now moving into our This Is Not Financial Advice segment. And I have to emphasize, this is strictly for educational purposes. We're just focusing on how different viewpoints can frame a trade idea. This is absolutely not investment advice.
Understood.
So given that intense volatility we saw, that massive swing, and the market's obsession with the short-term EPS noise from, the freight shift and that bonus accrual, the outrageous but plausible trade idea is a long position that leverages that multi-year story.
So you're suggesting the market is focusing on the noise of the turnaround, not the actual success of the strategy?
Precisely. The pitch would be to buy long-dated call options. Maybe something that expires out in January 2027 based on the conviction that management actually does it. They hit the $900 million in sales and that critical 42% gross margin target.
And you see the current volatility as the entry point.
Exactly. The near-term volatility, which is fueled by these temporary costs, creates what could be a favorable entry for a patient, growth-oriented investor. Someone willing to look past the next couple of quarters and bet on the successful execution of this AI-driven 650-store plan. The discount from the EPS noise is a short-term gift for a multi-year view.
It's a pure bet on management's ability to pivot from a sales turnaround to a profit turnaround.
Okay, to wrap this deep dive up, what we have is a company that is clearly executing a strategic transformation. They're capturing market share, they're benefiting from the trade down trend, and they're delivering powerful results. 5 straight quarters of comp growth.
But the path to sustained profitability is under this intense microscope because of the margin challenges. And even though we know the recent EPS miss was heavily influenced by temporary factors, the pressure is on. Management is betting that AI, loyalty, and targeted expansion can scale their niche format into a true off-price compounder by 2027.
So what does this all mean for you? As you follow this story, you should be considering this. The top-line acceleration is proven, but the bottom line is lagging. Which metric? The demonstrated ability to drive traffic or the pace and certainty of that margin recovery? Which one will ultimately dictate the stock's trajectory over the next 12 months? That's the key tension to watch.